In March 2020, the US national debt passed $38.5 trillion. And for the first time in history, the government spent over $1 trillion in a single year just on interest payments. That's more than the United States spends on national defense every year. Another way to think about it is for every $1 the government collects in taxes, roughly 20 cents now goes just to paying interest on the debt. And the crazy part is, we're not even paying the debt down. We're just issuing new debt to just pay off the old debt. But the real problem with this, the real danger, isn't that the United States suddenly can't pay its debt, because remember, it could always keep printing more money. The real danger is what happens when the Treasury market stops functioning. Because US Treasuries, they're not just government bonds, they're the foundation of the entire global financial system. And when that foundation cracks, everything built on top of it starts to break. So before we get into all of that, let's talk a bit about where we are right now. Right now, the US has over $38.5 trillion in total national debt. Roughly 31 trillion of that is held by the public. That means investors, banks, pension funds, foreign governments, and the Federal Reserve. The rest is money the government technically owes to itself through internal programs. But the real issue isn't just the size of the debt, it's the speed that it's growing. In 2024 alone, the federal government ran a $1.8 trillion deficit. That means it spent $1.8 trillion more than it collected in taxes. And deficits like that are now expected every year for decades. At the same time, interest costs are exploding. In 2017, the government paid an average interest rate of about 1.7% on its debt. Today, that number is closer to 3.4%. That might not sound dramatic, but when you're talking about tens of trillions of dollars, even small changes in interest rates massively increase borrowing costs. That's why interest payments now have crossed $1 trillion per year, and they're projected to reach 1.8 trillion within the next decade. And this is why economists are starting to worry, because the problem isn't just how much debt the US has, even though that is a problem. The real problem is how expensive that debt is becoming to maintain. Now, when most people hear US debt, they think the risk is that the government might not be able to pay it back someday. But that's not actually the biggest risk. The biggest risk is something much more dangerous. It's the possibility that the Treasury market stops functioning properly. Think of Treasuries like the base layer of finance. Everything else gets built on top of them. And the reason for that is because Treasuries are considered the risk-free benchmark. Every other loan in the economy, mortgages, corporate bonds, business loans, they get priced relative to Treasury yields. The reason Treasuries are considered risk-free is because they're backed by the US government, and everyone knows in the worst case scenario, the US government can just print money to pay the debt back. So every other type of loans that banks charge, they charge more interest than they could get from buying a Treasury bond, because it would never make sense to charge less. No other loan the bank makes will ever be as risk-free as a Treasury bond. So if a Treasury bond is offering 4%, the bank will never offer you or a business or anybody else less than that. They'll always charge more. The second thing you have to understand is that in the financial market, Treasury bonds are often used as collateral. Financial institutions use them to borrow money in repo markets, which are basically just markets where you can get a short-term loan and it has to be backed by a safe asset. And the third thing you have to understand is that Treasuries act as something called liquidity buffers. Banks, hedge funds, and pension funds hold them because they can sell them quickly to raise cash. And Treasuries are also the main channel for Federal Reserve policy. When the Fed wants to influence interest rates or financial conditions, it buys or sells Treasury bonds. And the actual scale of this market is enormous. There's roughly $900 billion in Treasury trades every single day. And on volatile days, that number can reach $1.5 trillion. And about $4 trillion per day in short-term financing, it happens in repo markets where institutions use Treasuries as collateral. So when people talk about the Treasury market, they're not just talking about like some small corner of finance. They're talking about the core infrastructure of the global financial system. And if that infrastructure were ever to start to break down, everything built on top of it would get unstable. And we've actually seen what that looks like before in March 2020 when the pandemic hit. During that time, you started to see markets panic and investors everywhere were rushing to raise cash. Institutions were selling their stocks, corporate bonds were getting sold, and then something strange happened. Investors actually started to sell US Treasuries, the one asset that's supposed to be the safest asset in the world. And normally, during crises, people would rush to buy Treasuries, and this time they were selling. This was known as the dash for cash. Everyone wanted dollars immediately. But the financial system, it couldn't handle all that selling pressure. Normally, large banks and dealers, they'll step in and buy Treasuries when investors are selling them. But in March 2020, a lot of bank balance sheets were already full. They couldn't absorb trillions of dollars of selling in the Treasury market. So what you started to see happening in the Treasury market, the most important market in the world, is that it was starting to break down and liquidity was starting to collapse. And when Treasury prices start falling fast, which should never happen during a global pandemic, because typically investors start buying them a lot, they're not selling them. But this time, the Federal Reserve had to step in and stabilize the market. And in just 1 month, the Fed bought $1.6 trillion in Treasuries. They didn't buy this to try to stimulate the economy, but literally just to stop the financial system from freezing up. And the crazy part is, that type of sell-off, that crisis, it didn't happen because the US government couldn't pay its debt. It happened because the Treasury market temporarily stopped functioning. Now, imagine that type of liquidity shock happening today, except now debt is 122% of GDP, not 105%. And interest costs are $1 trillion per year, not 500 billion. And foreign ownership of Treasuries has fallen from about 50% to about 29% today. In other words, the system is way more fragile today than it ever was in 2020. And there's another risk right now building inside the Treasury market. It's called the basis trade, and most people have never heard of it. But it could be one of the biggest triggers of the next financial crisis. Basically what it is sometimes the price of a Treasury bond and the price of a Treasury futures contract, they don't perfectly match. There's a tiny spread. That difference between those two prices is called the basis. Normally that difference is super tiny, but hedge funds try to exploit it. They'll buy the actual Treasury bond, then they'll sell the futures contract, and they'll earn the small price difference between the two. It only kind of makes sense for hedge funds to do that because they'll put in like billions of dollars. So even that tiny spread, they make good money. And hedge funds will also use massive leverage. They'll borrow huge amounts of money in the repo markets, and this lets them take positions dozens of times larger than their own capital. And by March 2025, leveraged funds, they held about $1 trillion in short-term Treasury positions. And when you include hedge funds operating through offshore vehicles, basically just doing like sketchy stuff in the Cayman Islands, researchers estimate the total size of the trade could exceed $2 trillion. The problem is what happens when markets move fast. If Treasury yields spike or repo funding becomes more expensive and hedge funds suddenly face margin calls, they have to unwind their positions very quickly. And that means they have to sell Treasuries. But when funds try to sell all at the same time, prices fall even further, and that triggers more margin calls, which triggers more forced selling. And you'll start to see repo lenders pulling back because they don't want all that risk. So what started as a small pricing trade can quickly turn into a liquidity spiral. And when that spiral hits the Treasury market, the Federal Reserve has to step in just like it did in March 2020. But the Fed, it may not step in forever, and the next time markets move the wrong way, that $2 trillion trade could unwind all at once, and you're going to see massive selling pressure on US Treasuries. So how does US debt actually turn into a financial crisis? There's basically 3 ways it could happen, and in a real crisis, they always happen at once. The first way would be through a debt service shock. When a country has a lot of debt, interest rates matter a lot because that debt constantly has to be refinanced. And right now, the US government is already spending $1 trillion per year just on interest. That's nearly 20% of all federal revenue. So if interest rates stay high or they rise even further, that number starts climbing. And investors, they start asking a simple question. If more and more tax revenue goes on interest, what happens to everything else like defense, infrastructure, or social programs? And it makes investors start worrying about the future of the economy, and they'll start demanding higher yields to keep lending the money. And higher yields make the problem worse because higher yields mean even higher interest costs, which leads to even more borrowing. That brings us to the next point, which is Treasury market dysfunction. And this is way more dangerous than the last thing we talked about because it happens inside the financial system itself. Remember earlier we talked about how treasuries are used as collateral by everyone, including banks, hedge funds, and repo markets. They're essentially the foundation of short-term lending. So if the treasury market becomes unstable, even temporarily, the shock spreads quickly. And the way it would typically start is something would cause treasury volatility. Maybe inflation surprises, maybe a weak bond auction, or maybe geopolitical stress. And traders, they would start demanding more protection when they're lending against treasuries. And that would cause repo funding to become more expensive. And when that happens, highly leveraged investors like hedge funds, they suddenly have to reduce their positions. So they start selling treasuries, and that selling pushes prices down more, which triggers margin calls, which forces even more selling. And suddenly, the most safe and important market in the world is stuck in a liquidity spiral. And when that happens, the Federal Reserve has to step in. Because remember, treasuries are not just government debt. They're the collateral behind the entire financial system. And the third way all of these things could cause a crisis is through political risk. The United States, periodically, it runs into debt ceiling standoffs. And even when the government doesn't default on the debt, that uncertainty alone can disrupt markets, especially money markets, repo desks. And when those markets become unstable, short-term lending markets, they get stressed. And that stress can start to spill over into the broader financial system. So what does a debt-driven financial crisis actually look like when it's happening? It usually starts pretty quietly, and the first signs, they'll show up inside the treasury market itself. You'll start to see bid-ask spreads widening a lot. That means it becomes harder to trade large amounts of treasuries without moving the price. You'll also start to see liquidity in certain bonds, especially older treasuries, they'll start to disappear. And yields, they'll begin making unusually large moves even when there's no obvious news. Sometimes treasury auctions, they start clearing at much higher yields than expected, and that's a sign that investors are demanding more compensation to buy the same debt. When that happens, you'd start to see stress spread into the repo market. Repo markets would start jumping above the Federal Reserve's policy rate, which would cause short-term funding to become harder to obtain. And once repo markets start tightening, leveraged investors would be forced to start selling assets, and that's when the real shock starts spilling into the economy. You'd start to see mortgage rates jump, corporate borrowing costs rise, banks would start to tighten lending standards, stocks and credit markets would start falling rapidly, and when you see all of those things happening at once, that's when you know the financial system is starting to break. So what does all of this actually mean? It does not mean that the US is about to default, and it does not mean that the financial system is about to collapse tomorrow. What it does mean is the modern financial system, it runs on a very specific piece of infrastructure, the treasury market. It also means what we said earlier. Treasuries are not just government debt. They're the foundation of the entire financial system. They're the collateral that banks use to borrow money. They're the benchmark that sets interest rates across the economy. And they're the tool the Federal Reserve uses to steer the economy. And all of this means that not only is the size of the US debt a problem, the real risk is kind of what happens if the market that supports all of that debt starts to lose stability. Because in modern finance, the biggest crises, they rarely start with defaults. They start when that kind of financial plumbing stops working. And when that happens, the system doesn't slowly break, it breaks all at once.